news. A reported secret meeting that you had recently, you and a bunch of other people with Zelensky of Ukraine. Within the last few weeks, it was said to have happened. What happened in that room?
So I don't know that it was so secret, but basically I think Zelensky wanted to meet people from the business community, and there were about 10 of us there. It was organized by JP Morgan, and it was, this is a pretty important person. I think when we look back in time in our history, he's played a very important role in the last couple of years, and it was an opportunity to sort of meet him firsthand. And I think his goal here, I think, was to meet people who could be potential investors in the country, people who could bring business to the country, and I think what he really had to say was, don't wait till after the war. You can really help us by bringing business to our country now.
Also looking for people to help rebuild after the war.
Yeah, I think, look, I'm very bullish on Ukraine post-war, right? I think most Americans wouldn't be able to identify Ukraine on the map circa 2 years ago. And today, I think people know, how many people live there, they know a lot about the population. I think they feel a moral obligation to help. And I think there'll be a very powerful big business case for the rebuilding of the country.
Are you going to commit personally that you'll give money towards the rebuild, either through you personally or the foundation?
So I've invested about $24 million in Ukraine philanthropically during the war.
You already have?
Already have. Some of that was a philanthropic investment in a company called Zipline, which is a really interesting startup. It's well beyond a startup. They apparently raised $400 million at a $4 billion valuation recently. But our philanthropic support was to get them to launch in Ukraine. And basically, it's a drone company that ships medical supplies, principally in Africa, but they places where there isn't good road infrastructure and you need to get blood from one hospital to another, or medical supplies or things like that. And they launched they're in the process of launching in Ukraine because, of course, the infrastructure of the country is not in a great place, and they have lots of need for blood in the right places, unfortunately.
And that was just the start, it sounds, to more investment from you?
It wasn't really, it was not an investment I was looking for an economic return. It was an investment I think it was not in their business plan to launch in Ukraine. And so actually got a call from Mike Moritz of Sequoia saying, look, we're actually looking for philanthropic support to bring Zipline to Ukraine. And I think and actually I had the opportunity to meet the head of logistics for the war at this meeting with Zelensky, and I connected him with the CEO of Zipline because, even in a place like Ukraine, there's a bureaucracy that you need to get through in order to, if you think about launching drones around Ukraine right now, you have to have a lot of confidence that those drones are good drones as opposed to bad ones.
It was a good segue to get to the markets because just within the last week, Jamie Dimon said that geopolitics remain the market's biggest risk. Do you agree?
I think I don't know, maybe in the very short term that's true. But I think, it's sort of the unknown. It's the ultimate sort of black swan type risk, right? What do you worry about? You worry about nuclear war. You worry about, an obligation to defend Taiwan. You worry about, war between the U.S. and we've gone from a period of, a couple decades of, put aside terrorism, which you can't really put aside, but we really haven't had war between major powers, two countries in Europe in, 80 years. And so this is not a bright time in our history. But we had a period of time where I think Berlin Wall came down and we thought about peace.
So it's a different environment to be investing in for a number of reasons, which we'll get to. How would you describe what your positioning is today?
So similar to what it's been historically, is we own actually really 8 amazing companies. I'm sure you know most of them. We have a tiny little investment in Fannie Mae and Freddie Mac, which I think together represent maybe a little over 1% of the portfolio. But the rest of those are really options on a ultimate kind of the government taking them out of conservatorship. The balance of the portfolio of great businesses we think do well in really any economic, political, or macro environment. And then we opportunistically hedge risks. And the 2 risks we've been concerned about really over the last it's a year and a half, energy prices and kind of the longer part of the curve, the Treasury curve becoming rates moving up.
Betting on the long end of the curve, rates continuing to go up. You nailed that, and you've been making that.
Well, nailed it would be we put this on like 18 months ago. We haven't made, we actually made almost $3 billion on 2-year rates. We've made a relatively modest profit here. So if we nailed it, we would have made more. But
are you still?
I sort of was quiet about it for a while, and then sort of made my point a couple months ago, and rates have moved a lot since.
Is it still on, that bet?
It is.
And how long will it be?
Well, until we're right or wrong.
I mean, are you still figuring that rates at the long end, the 30-year, for example, or however on the long end, are still going to go higher?
Yes. Look, I think there's, even in the relative short term, there are a number of reasons why rates can move a lot. Among them, right, we have a government shutdown. We're going into what looks like a highly probable government shutdown. We're going to have a data shutdown, right? All these little government agencies that put out data that the Federal Reserve relies on to decide whether to, adjust interest rates, they're going to lose access to that data. So we're going to have to sort of like kind of dark period. We have probably the worst technical environment in our lifetimes for supply of bonds versus buyer bonds, right? We have China selling. We have Russia, to the extent they own any U.S. securities, and more selling. We have Saudi Arabia selling. And we have an economy that is still strong, and inflation, 3.5%, 4%, and persistent. But our view is basically you're not being paid enough to enter into a 30-year contract with the U.S. government at a fixed price. 4.7 or wherever it is now. It doesn't make sense in a world where we think structural inflation is north of 3% for the very long term. We went through this very unusual period with extremely low interest rates, where everything just got cheaper. And since the financial crisis, the effort of the Federal Reserve was to make sure we didn't have deflation. The aspirational goal was to get to 2% inflation, and then the pandemic, and trillions of fiscal stimulus, the psychological stimulus of being free to roam after being locked up. All of these factors coming at once kind of lit inflation, and we still have this massive deficit spending. We still have infrastructure spending. The government's selling literally hundreds of billions of dollars of securities, bills, and at some point they're going to have to sell more and more of the longer instruments. And if you look at the balance sheet of the Federal Reserve, it's an imprudent balance sheet. If you think about the United States, right? If this were like a business, you wouldn't have so much short-term. You wouldn't have a third or more of your debt repricing within the next year. So it's not been managed. And I think actually Steve Mnuchin did a good job as Treasury Secretary. The one thing he missed is he should have issued a lot of 30-year, 50-year, 100-year paper at crazy low interest rates, and that's going to be a burden.
Hearing a lot from investors these days. Ken Griffin was on our network within the last week or so. I just had a conversation with Rick Reeder of BlackRock. Those who are talking about the possibility of much higher real rates for much longer than people think, for the very reasons that you're talking about. The issuance is so massive, and where are the buyers going to come from? And the result of that is going to be higher real yields.
I don't know about much higher real rates. I think again, my view is inflation, or kind of the house view is inflation is going to be persistently higher.
Well, you are the house.
I guess I control the door on the way in and out, I guess. But our view is really that we're in a different world, and the world sort of changes gradually, and you have a generation of people who are used to rates, 4 sounding like a high interest rate, and it's on a historical basis, it's an extremely low rate of interest. So I would not be shocked to rates well into the through the 5 barrier, and you could see the 10-year approach 5.
Jamie
and
Dimon.
that can happen in the very short term, like literally weeks. We've
10
seen
year.
a huge move in the last number of weeks, and I think a lot of that is investors kind of rethinking. What's interesting about the 30-year Treasury is people reflexively buy it whenever they, because they've made money doing it in advance of a recession. But it's really not an instrument you should use to speculate on the short-term economy. It's a fixed price contract with the U.S. government for 30 years, and reflects really structural forces, and I think the structural forces have changed.
You must be negative to the equity market. I joked at the outset that we haven't sat together in a while, and we certainly haven't done it here. And one of the last times we did was, Carl comes out, you guys give each other a hug, and it was this big moment. And it's hard to believe for me, and I wonder for you, that it's been 10 years since the Herbalife battle with Carl.
Yeah.
You believe it's been 10 years?
Yes. By the way, had we held our short, we'd be up like 70%. So I'm still psychologically short on that position where We've got a nice profit.
Are you still seeing ghosts at night?
By the way, being psychologically short is a much lower risk way.
Yeah.
Yeah.
Are you a changed investor from then? Are you different as an investor than you were 10 years ago? And if so, how?
Of course. I'm a continuous learning machine. And all mistakes are opportunities for learning. And so hopefully, I sort of decided at 50, I was like, okay, I'm not going to make any more mistakes. And I made one. But no, look, we've been very fortunate. We've had the best 5 years in the history of the firm. And we're fortunate in the way that we're structured. I've been a kind of Warren Buffett devotee, unofficial, he's been my unofficial mentor for many years. And if you look at his trajectory, he started out as what today you would call an activist hedge fund manager running a series of private partnerships. Over time, he took control of what he called a crappy textile company, or probably what was best described as a crappy textile company. But the access to the permanency of that capital gave him the ability to take kind of the very long-term view in a world where people in the investment management business generally have to make short-term decisions because their capital, it can leave. We really, 5 years ago, got to that place in terms of the structure of our organization, and allows us to take the kind of very long-term view. And we can buy Google at $94 a share when people are scared about and we can own it. And that, I think, is a very fortunate competitive advantage we have.
Are you a better risk manager today than you were before?
I certainly believe so. But I mean, look, short selling was never something we actually liked, like shorting stocks, because the asymmetry is in reverse. We're big believers in understanding asymmetry both in life and in investing is critically important, and short selling is on the inverse side of it. So we did that a couple of times. The first time very profitably, shorting bond insurers and Fannie Freddie going into the financial crisis, and then the famous Herbalife. But since then, all we do is we own really, really great businesses. And if you want to be a successful investor over time and you find a handful of great businesses, doing nothing but owning them is an amazing strategy. And it's underappreciated, if you will, as a successful way to make money.
Some would suggest that, and it was said on this stage earlier today by somebody who sold Alphabet when the ChatGPT and OpenAI thing came out.
So we bought from them, so we should thank them. Yes.
That the ball was fumbled and recovered by the other team, who ran for a touchdown and then piled on with other touchdowns. And now Alphabet may not be able to recover the leadership role that it had.
Yeah, I think that's...
DeepMind is a perfect example of Alphabet having this in-house and still fumbling the ball.
I would say they fumbled the PR around the ball. But I think they've subsequently demonstrated publicly that they are integrating AI in all of their various products. Obviously, the most obvious example is search. And they are, I think, their Bard is certainly neck and neck with ChatGPT. And we think they're, if you think about the enormous amounts of access to data that they have by virtue of the various, everything from search to the various products they offer to their customers, email and otherwise, data and the ability to legally extract and train on data is a really important competitive advantage. They also have designed their own chips, access to the cloud, access to the processing power is critical. So they've got many competitive advantages, and I think it's in some ways, in an integrated fashion, it gives them an enormous advantage. They will be a dominant player in AI for the very, very long term, we would expect.